In this week's update, valuation alone is no reason to desert the market, and learn from history and the legends. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, the anxiety in the market continues. The main point I want to make today is about trying to anticipate a correction that may or may not happen, or overall the subject of timing the market. It's almost impossible to do with some sort of reliability to pick tops and bottoms. In fact, it's so close to being almost impossible that I think it just about is. So we should control what we can control. And there are many things, and I'm sure you've heard me say this many times before, there are many things that we can control in the market, far more than are outside of our control. So just focus on them. And just manage probabilities. That's what investing is about. There are no certainties in investing. It's just about controlling where the highest probabilities exist. And it just takes some awareness of what it is that you can do. I'm sure most investors don't really understand the decision points that they actually have control over. And we only take actions that stack them in our favour. So therefore, it really has me scratching my head of late because of the incredible amount of negative narrative that's almost talking the market into a correction. And if we look at some of the greats from history, Peter Lynch, who was an absolute legend, ran the Magellan Mutual Fund, and he said something along the lines of far more money has been lost by investors anticipating corrections than has been lost in the corrections themselves. And to give you an idea of his track record, between 1977 and 1990, his mutual fund averaged 30% per annum, which is one of the best in history and far exceeds Warren Buffett's record. Yet not a lot of people seem to know about him unless you do reading in the area. But that was what he said, and it's just been proven to be true over and over again. So I'm seeing in what I read and absorb during the week that the roar of commentators who want to call the top is becoming deafening, and there's almost a universal theme there, and it's about valuations. They just think that valuations are insane. But what happens when you try to anticipate a correction is that you end up selling out too early out of fear. And one of the realities of the market is that you make the bulk of your money over a period of time from the really big winners. You've got a small handful of really big winners. So if you continually want to sell too early, you're never going to let those great assets unfold. You're never going to make the really big gains that really supports significant outperformance. And this defensive mindset that is so easy to fall into if you get caught up in the media narrative causes investors to miss out on the really big gains, the 5-baggers, the 10-baggers plus. And there are plenty of them. These are not hard entities to find. We have a handful of them every single year. So you've just got to be careful about allowing your mindset to get drawn down into this pit that the current narrative is digging. So if you're writing great assets, and put it in terms of a Melbourne Cup week, then just give them their head, let them run, as long as they remain great assets in terms of the business performance. There isn't anything much else to do. And turning to another quote from one of the foremost economists of our time, John Maynard Keynes, and I'm sure you've heard this one, the prices can rise further and for longer than anyone thinks. And I think that's where we're at the moment. Because prices have run quite a way, the natural inclination is to think, well, everything now is too expensive. It's run too far. But that's not it at all. So you don't bet against prevailing trends too early. Let the market show you the way. Let the market take you out. And I understand the anxiety of investors, because the investors that I talk to, almost no one has an exit plan. Everyone struggles with exiting more than anything else. So it's natural to be apprehensive if you have zero confidence around your ability to exit at an appropriate time. And we always exit a little bit after the top, because I'm driven by what the market is saying. observe and respond. And so if you are continually trying to anticipate where the top might be because you want to get out just before it, then it's just not the way to go. You'll leave so much money on the table, it's not funny. So the aim is to have an exiting process that's very clear. It's one that you can rely on and have confidence in, and you get out shortly after the top. And that's what we do in the Insiders Club. We've got a very clear 3-trigger exit strategy, and we've had that for years and years. So prices are driven not just by fundamentals, but by all those other emotional things: psychology, speculation, herd behavior. You don't want to get involved in any of that. Just let the market show you the way and control what you can control. As always, we advise that you obtain your own investment, financial, legal, and any other advice before taking action on anything which is in this video. Turning now to precious metals, gold was down $4 for the week to 4,000, so virtually flat. And in Aussie dollars, it actually moved up a little bit. 6,159 was where we finished. Incredibly profitable territory for Australian gold producers. Silver was down 1%, down to 48.32, but the long-term trends there are still very much unchanged and intact. And if you look at the gold chart, it's doing exactly what it should do. It's just retracing from a period of excess where it ran too far, too fast in a short period of time, and now it's moving into consolidation mode. But when you look at the charts, which we'll do in a minute, it's hard to argue that the trend is still not in force. And if we look at gold stocks, and I made these comments last week, I think it's appropriate to repeat them, that a short, sharp pullback is a sign of continued momentum if it's sustained. And at this point in time, that is what we've got, a short, sharp pullback. Now, if you want to let your mind run away with you and extrapolate that this is the start of a significant correction because someone told you it was, then that's one matter. But the fact is, the trend is unchanged. And until the market sends us a signal that that is different, then we continue on with what we're doing. When you'll see some of the turnarounds, not only in the gold stocks, but also in other stocks as well that occurred late in the week, and I think you'll really understand what it is that I'm saying. So it's really unwise to bet the house, trying to pick in this case now, a bottom in the market, because this market is nervous and it can do anything. But again, come back to the main point that I'm trying to make here. You respond to what the market gives you in arrears. Now, that doesn't mean that you get out too late, and that is a consequence of what some investors think, but it's just letting the market show you the way. It's just about managing risk effectively. We'll start first of all with silver. I'll come back to that NVIDIA chart. So there's silver on a daily chart. Where we were up here on the 16th of October, just look at the escalation. Look how far above this green 20-day moving average line that the price got. It had just gone exponential. That is not sustainable. So we've now got a sharp pullback. We're still above the 20-day moving average. That's how strong the trend is. We've just moved into a period of consolidation. This is exactly what you want to see. If you're in the gold market, don't fear yet what has transpired. Now, that could change, and we could take another leg down from here, but we'll deal with that at the time. We don't try to deal with that in advance, in fear that it might happen. Because you might own a 10-bagger gold stock, and if you sell it now, I promise you it's incredibly difficult to get back in at a lower price, and your psychology will take over. So you just let them go until we have definitive proof that something has changed. In the silver market, that is not the case. Neither is it in the gold market either. Look at the parabolic escalation that we had here. What is happening at the moment is healthy. It's pulled back to the 38.2% retracement level. That is a sign of continued strength. So you cannot look at that chart and draw any other conclusion other than the uptrend is still in place. And if we look at it in Aussie dollar terms, you can see we're still hugging the 8-day moving average. That is a sign of an incredibly strong trend. So that is the reality of the market, and you just don't want to get drawn into the narrative that would convince you to do something that is just not helpful to your portfolio. Turning now to American stocks, the S&P was down 1.6%. The NASDAQ, that should be falls, beg your pardon, just ignore that. So the NASDAQ was down 3% for the week. But interestingly, and not surprisingly, the RSP, which is the equal weight S&P index, so taking away that outsized effect of all the Mag 7 stocks on the S&P, it held up pretty well. It was only down fractionally and performed much better than the S&P did. So that's a good sign because it's telling you that we've got good breadth in the market. And the Russell was only down 1.8 as well. If this was a real top, a couple of things would have happened. The Russell would have fallen something like 4 or 5% or more. And we wouldn't have had a significant bounce on Friday as we did, because negative weeks that are the start of a major decline do not have a big bounce on Friday, closing on their absolute highs. Because the market is, just think about the psychology, the market is nervous. People are looking to get out. They're not going to buy to the maximum coming into a weekend. That doesn't mean it can't happen, but it would be incredibly unusual. It's not probable. So you've just got to understand what the market is saying and go from there. So I looked at several hundred US charts over the weekend before I recorded this video, as I always do. And when you look at a whole bunch of charts, not just the index, you get a much better picture of what's going on in the market. And there is very, very little that is scary in the charts. There's a couple of charts, but they're ones that probably produced poor earnings. So the price fell 10 or 20%. That's just absolutely normal. Be unusual if that wasn't the case. So I'm seeing very, very little that is scary in the charts at all to suggest that there is a broader swell of the sellers gaining control. On top of that, earnings season is looking good. The percentages of beats on revenue and earnings are coming in about where they normally would come in, and there is good growth. And the growth in earnings is more than was being predicted a month or 2 months ago. So the US market is nervous, there's no question, but this is a great market for long-term investors at this point in time, because you're being handed the opportunity to buy great assets at a price that you have been starved of getting. So you need to think about the market in a different way. And the strong bounce on Friday, as we'll see when we look at the charts, that says a lot, because it would be highly unusual to go into a weekend with a Friday finish like we did if this is a true market top and the start of a correction. Now, the US dollar index was down slightly, 99.5. The 10-year yield was up slightly, but look, these are very small moves. And the VIX moved up a little bit, but it's still below 20. So from my perspective, really nothing has changed in the charts. We're just getting a little bit of a breather. So I'll just start with the world's biggest stock, Nvidia, which is somewhere around the $5 trillion market cap at the moment. So this is what I'm talking about. We had a breakout. Now, their earnings are coming up, I think, on November 19, so we haven't had earnings from Nvidia yet, and that could change things. But all I've got to go on as an investor is the probability around what I can see. And at the moment, that is still absolutely fine. Now, let's look at what the market is telling us. We've had a couple of indecisive days, but they're small range candles and the volumes are really modest. Market tops are marked by a surge of smart money selling at the top, and you get much longer range candles, at least like this, but probably bigger, and you get a spike in volume. We've not really seen that. In fact, we've not seen that at all. And then, as I've said, on Friday leading into the weekend, you don't get this behavior. So just look at who's in control of the price action. The sellers were in control here. and here because we closed near the low of the day. And here, clearly, the sellers are winning the short-term battle. Then we gapped down on the open on Friday, so the seller's still in control. Traded down, sellers still in control. But somewhere during the day, the buyers grabbed back control and pushed the price all the way back up again and closed right on its high. And the volume was actually high, one of the highest of the week. That is not the probability that goes with a market top. The NASDAQ is telling you something almost identical. It's the same pattern. If we look at SMH, this is on a weekly chart. Let's look at it on a daily chart. It's exactly the same. The whole market has behaved in the same fashion. From Monday through to Thursday, and even into the start of the Friday session, the sellers had short-term control. But if you're a longer-term investor, that's going to happen 27 times during the life of that stock that you own. So you can't possibly be trying to jump out of the way every time the market for a few days or a few weeks has a little bit of a short-term pullback. You'll never get anywhere. The biggest winner you'll ever get will be 5 or 10%. You'll never get a 500% winner because you're choking the death out of it. So you've just got to understand how markets work. And another term that I've used, which I love from a great legendary investor, Ed Seykota, is you can't continue to breathe in without breathing out. Every now and again, the market has to take a step or two back. It's just the way it works. But that doesn't mean that we have to react to the short-term steps back. If we look at the relative comparison charts over the last month, we've seen a significant pullback in XLK. So that has pulled back quite sharply, but this is very short-term stuff. And we've seen a bit of a pullback also in consumer discretionary. This is all what you would expect to see. Materials lagging down the bottom, but there is nothing in this chart. Let me find consumer staples. Here's consumer staples down here. If this was a market top, consumer staples would be surging. The market would be moving into more defensive assets in a major way. It's not happening. And in Australia, we topped out on materials and have pulled back. We had a down week. We had a down week for small caps. And I'll have more to say on that in a minute. Banks have been pretty stable. Energy has picked up a little bit towards the end of the week, and certainly the information technology sector copped a bit of a hiding, and healthcare's at the bottom, thanks to the performance of CSL. There's the S&P, looks exactly like the NASDAQ. There's the RSP. Now, this one's really interesting because it hasn't pulled back to nearly a degree, but again, another index that closed on its high for the week. And finally, the Russell, the same thing. So from my perspective, at this point in time, it could change on Monday, but at this point in time, this is not a market to be concerned about that's falling into a correction, as many would have you believe. So that's the American market. Aussie stocks now, our dollar finished at 64.32. The RBA held steady just as expected. And look, they're really, if you can have any feelings towards the RBA or the Fed or any other central banks, they're really feeling the squeeze because they've got this conflict between inflation, which is not where they want it, the economy, and jobs. They've got these competing mandates that are heading in the wrong direction or heading in opposing directions, let me put it that way. Our index was down 1.2% for the week. It was profit-taking from my perspective, driven a lot by emotions. Yes, there was a few stocks that deserved to get hammered, but in many cases, the profit-taking that occurred had nothing to do with a shift in the long-term fundamentals. It was profit-taking driven by the fact that people had made a lot of money quickly and they were crystallising those gains. And the buyers just stepped back, leaving a little bit of a vacuum. And that's why some of the prices were a bit abrupt. And when it comes to small caps, it's absolutely normal in a nervous market for small caps to cop an outsized pullback. Again, it's just the way the market works. Turning to other commodities, copper slipped a little bit down under $5 now, $4.94, and it's really this flipping backwards and forwards between supply strength caused by supply issues and demand concerns around China and manufacturing around the rest of the world. And the market doesn't really know which signal to go by at the moment. And it's not helped, of course, with the US government shutdown, which is choking off some of the normal data points that markets need for direction. Crude oil slipped under $60. There was a bit of a rise in crude inventories as well that contributed to that. All right, the final message for this week, just buy great assets. Just investing is really simple. The problem is a psychological one. It's a psychological battle. Just buy great assets well. If you don't know how to identify great assets and you don't know how to buy them well, then get some assistance with that. And then just let them run. Don't be influenced by the short-term narrative. Ignore the news, ignore the consensus thinking. Just set your weights according to the unstoppable megatrends. These are points that I made last week because I struggle to find new points to make because there's only a limited number of very simple and obvious things that drive investment outperformance. And it's these things. All I'm doing is continually reminding everybody in the face of all this negative narrative, I'm just reminding viewers of this video of what the simple basics are that work really well. You just identify the best of the best in each sector. Why would you want to own anything else but the best of the best? Why would you want to own stocks just for the sake of diversity? It makes no sense. So just identify the best of the best, have more than what you need, be patient, wait for the dips, and just do that, and then rinse and repeat. It's not difficult. And certainly don't feel compelled to fiddle or to follow the crowd because you think that's a more comfortable place to be, following the crowd. It's also the more unprofitable place to be. Portfolio Analyst last week was an edition of Taking Stock, looking back at October. There's always huge amounts of learning in that. So for anyone that's looking to upskill themselves, spending a bit of time in Portfolio Analyst would enhance that a lot. And we also looked at the outlook for gold and the stocks to watch. So that was the week that was. There's more information on my website and there is my email address. I'll be back with you next Sunday. Cheers.